So we spoke about my introduction, and I've been working with contractors as well and clients as well as the financial institutions. So in today's discussion, we will look at factors that are affecting the returns and how what are the mitigating risks and how we can enhance the returns, and also understand the matrix, how the returns are evaluated. And then we summarize this discussion by listing out the key takeaways of our discussions today. So the factors affecting the returns, location and connectivity and the socio-infra are the primary characters that come into affecting the returns. So when we say location, uh, all that is in Whitefield is not the location which sells. So we need to be a little more specific in how we are selecting the location of a particular project, and all that which is connected by metro or a national highway will sell. That also has got a little more different sensitivity, and socio infra primarily face places a very important role while evaluating a particular project. And because what we are talking today is only about the residential. Residential, the primary affecting point would be socio-infra around. When I say socio-infra, it could be school, it could be hospitals, it could be the transport connectivity of metro or bus, or even auto rickshaws, or on a small 2 or 3 minutes wait or a 5 minutes wait, we get taxi connectivity. And then the every other dependency of the day, that is groceries, your supermarket, your mini markets. So just because we are on a highway, it doesn't sell, is what I'm trying to tell you when I'm saying about socio infra. So all the three has to be the basic need and the basic points while evaluating the particular project. And then comes the project planning and approvals. Here, planning has got different meanings in an architect's perspective, and an engineer perspective, and a businessman's perspective. For an architect, given an input by the client, they define and do the planning. But for an engineer, the planning goes the other way around. Given a project with various towers, he will start constructing the towers. That's what becomes a planning for him. And then the right product mix is the one, the planning of a right product mix comes from the marketing team. For them, the planning is different. And the sales team, the same right product mix sales team speaks in a different languages. So we'll have to gather all the information while planning project here. Very particularly, the architects has to ask several questions about the right product mix, because unless you have a right product mix on your project, sellability becomes a challenge. And also planning in an architect's perspective, and related to that, the approvals. What are the minimal areas as per the standard bylaws, and how many number of car parking? Just because the client gives you 3 bedroom, 1500 square feet, are we supposed to do 1500 square feet? Are we going to carve out a little bigger one? Are we supposed to carve out a smaller one? You need to give that kind of an insight to the builder as well. And that is where the other parameters comes in terms of approvals, number of basement, the still parking, number of higher floors, then the fire compliances, then the setback compliances. All other matters will come into picture. The micro market survey of a particular project location, wherein we have to evaluate the entire probably 1 kilometer or a 3 kilometer or a 5 kilometer radius of the project for its sales velocity. Just because I like the land, just because the land has come to me at a lesser price, just because I'm doing a joint development, we cannot ignore the sales velocity, because sales velocity is the one which keeps the project running. I'll give you a small tabulation of how the sales velocity can alter the entire returns and the dynamics of your construction as well. So that is where we have to come into we have to evaluate about the market demand and also the sales velocity. This also is one of the factors that affects your returns. And then the important thing about after doing all that location, then the micro market, then the approval, the hard line of the project is on the financing. If you are not able to manage the cash flows properly, then the whatever effort you have put, whatever skilled people you are putting on to do the sales or doing the construction, it doesn't work. So I'll in the further slides, I'll explain to you about how the cash flow management and how it affects your returns and how it can be tweaked and altered to make the profitability look good. And the regulatory changes, we need to always be abreast about the regulatory changes. Of recently, Arnold DCM was talking about allowing any wastements at all. So if there is a planning that is getting done at your office or a discussion that is happening, the project might come into reality or the groundbreaking can come in 1 year, then you need to be thinking about whatever the statement the DCM has given, will that come into reality or not? If it comes by the time you go for approval, what could be the effect? Like this RERA and GST was taken, had come to the people as a surprise about 6-7 years before. Nobody were about that this kind of a stringent regulatory norms would come up. So that it took almost about 2 or 3 years for people to settle down among the regulatory changes. And like in the last 10 years, we are also fighting about the TDR that also has affected the market. So we need to be abreast about the regulatory changes, which might also affect your returns on the project. And then the construction management, wherein the sequence, the quality, and the right partners becomes a criteria. When I say sequence, assuming there are about 5 towers, which tower has to go first and which tower has to go last is the sequence what we are talking about. Now, when we say tower 1 has to go first, there are 2 criteria in my perspective. The tower 1, because it is in the corner of the project, it is easy to construct, and then it allows us to sequence our work and in a chronological manner. But what if tower 1 is a 4-bedroom apartment and not a sellable product in the market? So that is where the sequence comes in. Now, even here also, the 4-bedroom apartment among the 5 towers, this particular tower 1 is 4-bedroom, which is a slow sales. Then a logical thinking has to be applied whether we have to construct the tower 1 first, just because it is in the corner of the project and we have to come out sequentially, because that helps us the logistics of the project. So that is where the sequence of the project comes in, wherein both the sales and the marketing team's input as well as the construction challenges has to be taken care. That is what I mean when I say the sequence. In one of the project, we have done all the 4 bedrooms first and the 1 bedroom last. So 1 bedroom were sold out like hotcake because the demand was there. But 1 bedroom we sold it at 1.5 times the price of a 4-bedroom apartment. So that is a risk what we had taken at that point of time. Though the 4-bedroom sales, we knew it is going to be slow. So that sequence adjustment once again becomes one of the factors. And then the quality, a small quality defect, though even if it is rectified, makes the customer unhappy, and then that becomes a negative campaign. And then the right partners, if we are not having the right contractor on site, and he's not able to mobilize people or not able to adhere to the quality or not able to adhere to the time, then the project returns gets affected. So that is where the construction management also comes into factor for the returns. And then, as I said, if the partners delays, your cost overruns and the time overruns. And the methodology of construction also plays an important role. There are a lot of analysis where we have to choose a conventional method, where we have to choose my one, where does my one shuttering breaks even in the cost, where does precast breaks even the cost, whereas tunnel forum can break even the cost. There are various factors. Probably in next one or the other forum, I'll be able to give you that kind of a perspective as well. How you can advise the builder or your client to choose what methodology of construction has to be chosen to keep up the pace of construction as well as expect the returns on time. Previous slides, we were talking about the location, socio infrastructure, connectivity. In the past, I have done to an extent of 5 kilometer radius of all the apartments. Now, given a project of 3 acres or 5 acres, we have done the feasibility studies of sales and marketing and the product also from the competition within the market of 5 kilometer radius from the subject project. We gather all the information, who is selling it at what price, what category builder he is, am I equivalent to Prestige or am I equivalent to any category C builder? So who are my competitors? What are they selling it at? Are there any deviations? Is any project stuck? What type of customers are buying that kind of a project in a category A builder or a category C builder? So that kind of a feasibility study has to be carried out before getting into any of the project. So that is where probably as an architect or a project management consultant or an advisor of a developer can come into picture to advise him in the right direction. And then phase-wise development strategy, just like before 2 minutes I explained to you, uh, tower 1, tower 2, tower 3, when what bedroom has to go first, what tower has to come first, and what other infrastructure that can go parallel to tower 1, 2, 3, and how has to be the access and for the ingress and egress of the construction equipments. All that comes into the picture. Apart from that, in the recent past, most of the apartment projects are surrounded by habitat area. So we need to consider the nuisances and the noise level that will be generated because of the project. Accordingly, we'll have to face the development and construction as well. And then strategic partnership with contractors or investors. Contractor is one side, he's the one who is producing your product. So the person who produces your product has to be right partner with you. Along with that, the investor as well. An investor has to have that kind of a patience and that kind of a sustenance within himself to bear with you or whatever is happening around the project, so that the developer can perform well. The developer, when I say developer, it is a complete team of his architect, team of his project management consultant, his design consultants, whoever it is. So both investor and the contractor, because of the investor, the business has come in picture. This particular project has come into picture. Because of the contractor, this project is getting shape. So one is on the top end, another one is on the fag end. So both have to be there to perform. Then only the project can be successful. That is where we'll have to give good amount of time and while selecting the contractors and also your investment partners. And then we'll have to use the proper financial models to evaluate whether the project is performable, whether it is viable. Can we go ahead with the project? Unless we have a logical and a scientific method of evaluating whether it is going to perform or not, we should not be getting into the project at all. So such models are DCF and IRR, or the break-even analysis. DCF is discounted cash flows and IRR is internal rate of return. Both are a little different complex evaluation method. DCFs are generally done by the bankers. IRR calculations are done by the builders. IRR and the break-even analysis are done by the builders. DCF method is used by the bankers to evaluate the value of the project while sanctioning the loan and all that. So while entering into the project, if you are able to do both DCF and IRR, then the DCF gives you an hint of whether this particular project we can avail loan, what will be the loan, what will be the nitty-gritties of availing the loan, and all that factors. The next point would be on the liquidity cushion and also the contingency plan. While we put up a lot of Microsoft Excel tabulations to arrive at our more precise numbers, all said and done, for certain, we need to have a contingency planning. There could be one or the other hindrances that could stop the project or that could delay your project, that could call for a different method of design or a different sequence of working. So wherein we need liquidity cushion. So this kind of a factor always we need to accommodate within our project evaluation methods. There are tools to evaluate investment returns, which are ROI and IRR models are the extensively used one. ROI is return on investment. And then we have to conduct the sensitivity analysis, which is cost and revenue variation. The cost and revenue variation, to make it simple for you guys to understand, cost goes lower, your profit goes higher. So if you can save 100 rupees per square feet, your profit has already gone up by 100 rupees. That is what is the sensitivity analysis. While we do larger projects, we go into the depth of even procurement sensitivity also. Just to quote an example, if today's steel price is 55 rupees and my project calls for 10,000 tons, might as well I place a order on 1,000 tons, which is a consumption of 1 quarter. So that is how we get into sensitivity analysis. And on a 1,000 tons, if I am saving 1,000 rupees, it's a good amount of money saved there. So because it's a non-perishable item, we cannot do the same thing on the cement. Having said that, so steel is something that way, and probably even while buying the aluminium formwork as well, we play the similar role. And even in the cement as well, we do it while we lock the prices with the manufacturers itself. That all happens when we are doing quite a larger project. So cost is a very sensitive element of any profitability. So we need to have the sensitivity analysis, and generally we always have an analyst along with the project head to conduct such kind of a sensitivity analysis. And then the waterfall distribution models for investor profit sharing. This I will address in the subsequent slides. You will better understand that. Waterfall distribution model is a model generally what all other formal investors understand, like any of the corporate finances or the financial institutions perform or analyzes our project in this way. ROI is as simple as return on investment, IRR is internal rate of return, and MOIC is multiple on invested capital. ROI is it's a quick and simple calculation. I have invested 10 crores, I got 25 crores. I got a 5 crore profit. It is about 50% of my 50% of my investment is my return. That's a profitability. And then IRR is a time adjusted calculation, which in the next slide I will address it in a detailed manner. And capital multiple is I have invested 10 crore and I have made 25 crores of business. So my capital has grown 2.5 times fold is what we generally look at. So this ROI and multiple are generally everyone uses this, but factually that is a little wrong, leads to you in a wrong direction. But it is not completely wrong. Mathematically and arithmetically, they are two right way of evaluating, but not on the performance level. So that is where I bring in this IRR method to make it more easy for understanding. See, here I've given you the both ROI and multiple of capital calculations here. I've invested 11 crores and then I've incurred a cost of 9 crores. My sale revenue is 25 crores. I made a profit of 5 crores. So 5 divided by 11 is 45%. That's the return on investment because I invested 11 crores. Here it ignores the time value of the money and also the cost involved in producing that particular product. Capital multiple is once again, I invested 11 crores and my business turned out to be 25 crores. So it is 2.27 fold of my investment. Once again, this also ignores the duration of fund utilization. Also, ignores the cost which is involved in it. See here, what I've done is I've put all the cost in a cash flow model. Wherever, if you see the cost on the top 5-6 rows, if my investment is my capital, what I'm bringing in is about 11 crores, but I'm not going to put all the 11 crores on the day one. First, the land acquisition goes in, and then the design goes in. Design also, even if my budget is 1 crore, I'm not spending all the 1 crore on the first quarter or the second quarter. It is spread over few months, few quarters. And same is the approval as well. On the day one, I acquire the land, I don't need the money for approval. Once the design is completed, the approval plan is ready, I need the money. So I bring in that money in the second quarter. And then I've kept about 2 crores of working capital. That's WC is working capital for immediate start of the construction work, and then the marketing campaign and the advances for the material, advances for the contractor, likewise. So if you notice here, the first 3 quarters, all your investment has gone in a phased manner. It has not gone on the first day. Whereas in your ROI calculation, you are calculating the 11 crores on the day one. And then the cost of construction, COC mean to say cost of construction. Once your approval plan is ready and in 1 quarter or 2 quarters, your construction kicks in and your cash outflows, paying to the contractors all kicks in. And then for an example, I considered about 5 quarter. M&S is the marketing and sales. So that also is split into 6 quarters. And COF is the cost of fund. Now it all depends upon how you have borrowed the fund. You have brought in the money which is available in your bank balance, all the 10 crores or 7 crores, fine. If you have borrowed the money from outside, then the servicing of the interest of that particular money from the market kicks in. Here, I have marked it in red text, which I have considered as 16% per annum, which is a very conservative side. Just for the calculation purpose, I have considered 16%. 16% of the 7.5 crores has to be served in that particular quarter. That's why it is about 34 lakh rupees it comes out to. Once the cost, I have tabulated the cost in a manner how it will be spent. We'll have to tabulate the sales also, how the sales revenue comes in. Now, just because I've taken the land, as per the RERA, I will not be able to market also until the RERA application is cleared. So once your approval is done, just before the construction, your sales, you're launching the project, doing the marketing activities. I'm assuming on the first quarter, we are doing, because of the intense marketing, we are able to sell 20% of the inventory. And then likewise, I've distributed into 6 quarters. And then the sales receivables, that the moment you sell, you will not get all the money of the sale value. You'll get only 5%, 15%, 20%, likewise until the project is getting completed. So somebody says, I've sold 5 crores. It doesn't mean he has earned 5 crores. He has earned only 5% of the 5 crores as the booking amount. So we'll have to put the collectibles also in a proper cash flow. This is what in the previous slide we were talking about waterfall mechanism. If you notice on the sales receivable further, all that 5-6 lines of receivables has been put in. That's called the waterfall mechanism. And then the total sales revenue per quarter is evaluated. Total outflow is the cost. Total inflow is the sales. We net it off. Inflow minus outflow. We get the number there. If you see the net cash flow, there are few figures which I have marked it in the red. There are few figures which I have marked it in the black. This red color is the one which is going out of your pocket when you have started the project. 7.84, 94 lakhs, 2.59, 1.05 crores. This is your negative cash flow. If you sum it up, it lands up to 12.42 crores. Whereas in my previous slide, we were looking at 11 crores as my investment. No, it will not be 11 crores, it will be 12.42 crores. 11 crores is a rounded up number on an assumption. This is a more precise number which has come through a proper cash flow mechanism. So you need 12.42 crores until unless you become a positive. That is, on the quarter 5, if you see 44 lakhs, you become a positive there. Can you move the cursor there on the quarter 5 bottommost? 44. Thereafter, if you see all other are positive cash flows, that is where you started making the money. 2.85, 3.83, 6.55, and then the 3.15, the last one. That is where you have started making the money. So if somebody is saying, I'll pay you in 1.5 years because I'm making 2.27 multiple, in 1.5 years I'll give you 2 multiple, then we are on the wrong direction. We are on a wrong direction. Somebody has not understood it rightly, and we are in the wrong direction. So there is a function to calculate the IRR, internal rate of return. There is a function in Excel which is time related. All that negative cash flow and the positive cash flow related to the quarter there on the top second line, no? 1st July, 30th September, 30th December, and all that. If we correlate that number, I'll give you the function towards the end of this discussion. I'll give you the function of it. This 29.85 is the project IRR, whereas in the previous slide you saw 45% is my return on investment. So once again, it is giving a wrong direction. Arithmetically, that is correct, but we are moving in a wrong direction. Project multiple, there you saw 2.27 as a multiple because you thought invested 11 crores, made 25 crores, but you ignored that 9 crores of the cost there. As per the arithmetic method, that multiple is correct only, but we have ignored the cost in the previous method of multiple calculation. Here in IRR method, this is that the sum of all that red text divided by the sum of the positive cash flows, the negative cash flows and the positive cash flows. So if you have invested 12.42 crores as per the cash flow, you have brought in 25 crores revenue into the project. That is the multiple. 0.65 is the multiple that way. It's not what you have invested 11 crores and made it 25 crores. Okay. This is only a small perspective about how different products, asset classes are behaving in the market. If you see on the top of the table, it's real estate gives you an average of 12 to 20%. Anything lesser than 12%, we should not be doing any real estate project at all. And the risk level is medium to high. It depends. Why? When I say medium to high, because of the size what you can take up to. Liquidity is very low here because your product is a high cost product and product is sold when it is sold. And time horizon is also a longer period compared to any other asset class. Capital requirement is high here. That is why you have got returns also high. Otherwise, the other products, if you see, capital requirement is low or medium, but here it is high. The return also is high. Inflation hedge, yes, this is very strong against the inflation hedge. Among real estate projects, I got another one classification also, which are the most apt one you can select. Like plotted development gives you a good return, 20 to 25%. Risk is high. When risk is high, gain also is high. Residential apartment 12 to 18%, medium because apartment is something need and necessary of everyone in the metro cities. Commercial leasing returns are less, risk is also medium only, not much, but it largely depend upon where you have done your project. Occupancy and tenant quality is also which part of the city, which corridor of the city you are doing a commercial. And then joint development also fetches you. Joint development, be it apartment or a residential plot, gives you higher return. Once again, the risk also is a little higher there because here the stakeholder is the landowner. If the landowner or landowner's relatives misbehaves, you are on the stake. You are at the stake here. Whatever kind of a legal binding you do with the landowner or anybody, having said, our legal framework takes its own time. So that's the reason JDA is a little tricky situation. You need to be extra cautious there.